All right, welcome to our explainer on Cambodia's 2014 insurance law. We're going to break down this really important document into something clear and easy to get your head around.
So let's start with a big question. How do you build an entire industry on, well, basically a promise? I mean, think about it. Insurance is just that, right? A promise that if something bad happens down the road, someone will be there to help cover the cost. But for a whole market to work, for people to actually believe in that promise, you need a rock-solid foundation. And that's exactly how you do it. You write a clear, powerful rulebook. And today, we're diving deep into the official rulebook for Cambodia's insurance sector, the 2014 Law on Insurance. This thing sets all the ground rules for how the game is played. Okay, so what's this law actually trying to do? Well, right in the first two articles, it lays out its purpose, and it's crystal clear. This isn't just about shuffling money around. It's about building a modern, reliable industry from scratch. The main goals? Make sure the whole sector can last, build up public trust, and, most importantly, protect the actual people who are buying the insurance. Because without that trust, that whole system of promises, it just falls apart.
So let's get down to the most fundamental piece of this entire puzzle. We're talking about the legal heart of every single insurance deal, the contract itself.
At its core, the law says an insurance contract is a pretty simple exchange, and it has to be in writing. You, the insured person, pay a fee, which we call the premium. And in return for that, the insurance company agrees to take on a very specific risk for you. Simple concept, right? But oh man, the details are everything.
Now this is where it gets really interesting. The law doesn't see this as just a cold financial transaction. Article 9 makes it clear that the whole thing has to be built on good faith, mutual benefits, and unanimity. What does that mean? It means it's a partnership. Both sides have to be totally honest with each other. That's the good faith part. And you both have to agree on every single term for that promise to be valid.
And to make sure there are absolutely no gray areas, Article 12 says you have to be incredibly specific. The contract must spell out in black and white who's involved, what is being insured, the exact risks that are covered, the total amount of coverage, how much it costs, and for how long. There is zero room for confusion.
All right, so the law basically splits the world of insurance into two big categories. They cover very different things, and as you're about to see, they operate under a completely different key principle. So on one hand, you've got general insurance. This is the stuff that covers your property, your health, your car, that kind of thing. The key feature here is a legal term called subrogation. It basically means that if someone else damages your insured property, your insurer can pay your claim, and then they can step into your shoes and sue the person who caused the damage to get their money back. But on the other hand, you have life insurance. This is totally different. After the insurer pays out a claim for a death, they have no right of subrogation. They can't go after a third party. This really shows you the deep down difference in how these two kinds of insurance promises are designed to work.
Okay, pay attention, because this next part is critical. It affects pretty much everyone, whether you're running a business or just driving your car around Cambodia. Some insurance, it's not optional. It's required by law. The law points to 3 specific types of liability insurance that you absolutely must have, and it's all about protecting the public. First, if you own a motor vehicle, you have to have liability coverage, no way around it. Second, if you're running a construction site, you need insurance in place before a single shovel hits the dirt. And finally, if your business transports people, doesn't matter if it's by road, boat, or plane, you've got to have liability insurance for your passengers. These are not just good ideas, they're the law.
So, who's the referee here? Who makes sure everyone is playing by this rulebook? And more importantly, what happens if you decide to break the rules? This is where we get into regulation and the pretty serious consequences.
The law makes this part super simple. There is one, and only one, competent authority in charge of managing and supervising the entire insurance industry. And that is the Ministry of Economy and Finance. They're the ones in charge. The buck stops there. And the law saves some of its harshest penalties for anyone who tries to sell insurance without being an official, licensed part of the system. I mean, it makes sense. Doing that is a huge threat to public trust and could destabilize the whole market. And we are talking about substantial penalties here. Getting caught operating without a license the first time can land you a fine up to 100 million reals. But if you're a repeat offender, the fines double for a person and they quadruple for a company. On top of that, individuals could even face 1 to 5 years in prison. The message is loud and clear. Play by the rules or get ready to pay the price. So let's just boil this all down, shall we? The 2014 law on insurance is a complete blueprint. It starts with the big why, to build trust. It defines the contract as the absolute core of the system, built on honesty. It forces certain coverages to protect the public, and it backs the whole thing up with one single regulator and some very serious penalties.
At the end of the day, this law provides that official blueprint, right? It gives you the rules, the structure, everything you need for a secure market. But that leaves us with one final thought. A law can create the foundation for trust, but building a real culture of confidence, well, that's an ongoing job for everyone involved. The regulators, the companies, and of course the public, they all exist to serve.